Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Alrighty, welcome to the Smart Investing Show. I'm your host, Chase Wilsey, for today, and with me we have our financial planner, certified financial planner, I guess I could say.
Don't forget that.
Can't forget that. CFP Harrison Johnson. Got a full show here today. We're going to talk a lot about this jobs report. I mean, that really, I'm going to say, spooked markets. We'll dig into the details of what happened there. We'll also talk a little bit about the JOLTs survey. That came out earlier in the week, but obviously relates to the employment situation. We'll then talk about GDP. I got to say, it was a heavy week in terms of economic data. So excited to kind of pair that with the labor market. You'll get a good understanding of where we think the economy is at this point in time. And then lastly, just a kind of unique topic here, but should banks be responsible when people get scammed? Good question. I guess we'll hash it out.
We'll talk about it, yeah.
And companies we're going to discuss today includes Hasbro, Chipotle, and then also too Baker Hughes, who just made an acquisition. And our financial planning topic of the day is, we know about Roth accounts. We know the tax benefits that come with them, but maybe some hidden benefits. I don't want to say hidden, but maybe some secondary benefits you're not fully thinking about.
Yeah, should be fun. Roth accounts. It depends on the situation, but we'll get into it.
Yeah. So let's jump into it. As you said, we're going to start off again with that jobs report. I mean, as I said, it spooked markets. I see the S&P, the NASDAQ fell pretty heavily on the trading day Friday. NASDAQ was down, I think, over 2%. Mm-hmm. S&P was down 1.6%, it appears. So definitely hurt things. And reason being, I mean, I'm going to start with this. It missed expectations, to say the least. July nonfarm payrolls grew by 73,000. The estimate was 100,000. You might be saying, well, that doesn't sound that bad, right? Well, when you dig into the numbers, I mean, there are some big concerns. The big concerns stem from the prior 2 months saw major negative revisions, as June was revised from 147,000 to just 14,000. And then May, well, that was revised from 125,000 to just 19,000. This amounted to a total negative revision of 258,000 jobs when looking at the last 2 months combined.
Yeah, I mean, that's a big number. When you're expecting 150 and you get 15, close to it, that's a big decline. And I mean, the markets have been going up pretty consistently. So, looking at it a little bit further back, things are still good on the year, good even on the month. Month ended fine, but there might be some cracks out there.
There might be some cracks. I mean, the way I kind of look at this as well is it's let's say you had an expectation for 300,000, right? I'm just going to throw that number out there. And you came in at, what did I say, it was 258? You came in at 50,000. I mean, that'd be terrible. You'd be like, oh my gosh. And that's kind of what happened, because the revisions were so large that, I mean, it was shocking. I mean, that is a huge change. And the other thing that concerned me was the job growth, I'm going to say, wasn't even robust. And the reason I say that is it was so reliant on healthcare and social assistance. That category added 73,300 jobs in the month. Again, the headline total, 73,000. So basically all the jobs came from just that one category.
Right.
We're not used to, again, seeing a labor market that's had cracks like this.
Right, yeah. Retail trading added 15,700 jobs. Leisure and hospitality added 5,000. Construction with 2,000. There's some categories that saw declines. Government was down 10,000 jobs. Manufacturing declined by 11,000. Professional and business services declined by 14,000. So, a lot of out there, losing jobs as well.
Yeah, and that's where things get concerning is, I mean, coming in at, again, 73,000, having slow growth for 2 months. I mean, even if you say, let's have growth of 50,000 jobs a month, I mean, that's not going to be a bad economy. You still have a growing labor market. That's good. The question is, if we flip to negative payroll data, that's where you could be tilting towards some scary news here.
Yeah, and that can go bad very quickly. So, having negative numbers, or kind of as you said previously, which jobs are receiving the growth, because not all jobs are the same. We want good, high-quality jobs to be growing, and, with retail trading be a big number there. It's
a volatile category, because sometimes they might be gearing up for the summer months, and then, maybe kids go, that's a good one for college students, maybe a good one for high school students. to kind of work in the retail environment, and all of a sudden they go back to school. They're like, oh, I don't need the job anymore. I mean, that one can be, I'm going to say, a more volatile category than you see with, again, looking at professional and business services, where that's generally where you're going to find longer-term careers.
Right. Yeah. So seeing a decline on that one, that's a little frightening there.
Yeah. And I got to say, I mean, all this sounds negative, but I still wouldn't panic over this report. The main reason is the unemployment rate remains historically low at 4.2%, and layoffs have not materially increased. And I would even make the claim that the unemployment rate is healthier than it appears. Now, why do I say that? If you look at the average weeks unemployed, that now stands at 24.1. And those that have been unemployed for more than 27 weeks, that jumped to 1.82 million people, which is about 1/4 of all the unemployed. I mean, if you've been unemployed for 27 weeks during this labor market, I hate to say it, but I mean, how hard are you really looking? Can you truly be counted as unemployed if that is the data?
Right. Yeah. I mean, that's always especially right now with the time of the year that we're going on, there's a lot of people moving around. And I think that there's people out there that maybe because of the way the market's gone, they have a little bit of cash in their pocket. And so they're holding out on, what they think they're worth. And so, that's lasting a little bbit longer, when really, if you need a job, you might need to get a temporary job. Doesn't have to be your long-term career, but, I think there's a little holding out there.
And I mean, I'll kind of get to this in a little bit more detail in just a second here. But the other thing that I wonder with those, 1.8 million people that have been unemployed for 27 weeks, how many of those people are, somebody, let's say 62, maybe they got laid off, maybe they were looking for a different job, and they're like, I could retire.
I know that there's people in there because we have clients that do that.
Yeah.
That something happened, they get laid off, or they just, don't want to do that anymore, whatever it is, and then they're looking around, and they're interviewing here and there, but it's not really what they want to do, so it's not something that they want to pursue. So they're in that age where they could be working, they're in the workforce, but also, they have the assets of like, maybe I will just retire.
Yeah, so I mean, that's where I look at, again, we got some, I'm going to say questionable data here from the labor market and the payroll data. But again, you have to understand the unemployment rate is still healthy. We still have a healthy labor market at this point in time. Things can always change. But as of today, I would say the labor market still looks good. And the other thing, too, when I look at, again, that low unemployment rate, I talked about low layoffs. And people might be, oh, no, I hear all the time people are getting laid off. Well, let's look at the data. June layoffs actually totaled 1.6 million. And really, since about 2021, they have maintained that level, with the average monthly total since January 2021 standing around 1.57 million. If we look pre-COVID, from December 2000, which is when the data first started, to February 2020, layoffs averaged 1.91 million per month. So we've really seen a low amount of layoffs compared to historical standards. We have a low unemployment rate. It really seems like a lot of companies at this point are saying, well, we're not going to fire anyone, but maybe we're not going to look as aggressively for people.
And I think, those numbers that you pointed out are really important. Again, layoffs averaged 1.91 million from 2000 to 2020, that 20-year gap, 2 decades, 1.91 million. And in June, we saw 1.6 million. So, you see these layoffs, but historically, that's actually, a relatively low number.
Yeah, and I think that's where, again, you will always hear companies with layoffs. It's going to be part of the labor market. It's just going to happen. But, again, you have to look at the whole economy. And you have to understand, too, a small business, it starts with a large part of the economy. And, frankly, it doesn't capture the headlines like Microsoft announcing a layoff, like Meta announcing a layoff. That's going to capture the headlines. But, Joe Smith Plumbing Company that has 200 employees announces a layoff of 5 people. That's not newsworthy. So you have to understand that small business component really drives a lot of the employment situation, but it appears they're not doing many layoffs at this point in time. And it seems like the economy as a whole, the labor market as a whole, layoffs still look okay.
Yeah, and I think, large companies are the ones that do more of layoffs anyway, because they might be shifting their business around. They're going into a different market. They have a different service or product that they're going, and they're getting away from something that's less profitable. So they have, a whole catalog of different products and services, and they want to go after what's going to make the most money. And that might be, well, we don't need these types of workers for this product line anymore. We're going to now lay those people off and then hire more to do this type of, skilled labor, whatever it is.
Yeah. And one thing too that I look at with this jobs report is, it's just one one data point. And obviously we had 2 negative revisions, so you could argue maybe it's 3 data points of questionable data. But we got 1 bad data point, 1 day of bad news. I am curious if we will get, a little bit more positive news on the employment market going forward. And the reason I say that is we do have a little bit more clarity on the trade deals and tariffs now. We've seen all the different trade deal announcements. Obviously, China's still a wild card. Canada, Mexico, those 2 countries, major trading partners, still a wild card there. But at least companies now having a little bit more clarity. I wonder, as I said, a lot of businesses were saying, maybe we're not going to hire over that 3-month period. That is really when tariffs were, April, May, June. That's when tariffs really kind of rocking the market and coming like, I don't know. Could we have that clarity? And then maybe this is just that 1 bad month of data points. And now we kind of bottom out and we start to see, I don't think a robust labor market. We're going to see huge payroll gains, but again, stabilized gains, which is really, I think, going to be healthy for the economy, for the labor market as a whole.
Yeah, so it's going to be really important to see what the next reports come out so we can see if there's any trends going on, because 1 data point by itself doesn't always tell you a lot. So what is the labor market? What is what are those numbers going to look like in the next couple of months or into the next quarter?
And the trade noise, I think, created so much noise in the economy. We'll get to more of that during the GDP. But again, I wonder how much it impacted the labor market. Could this just be a blip where it's like there's so much confusion, there's so much messiness, where we get back into, October, November, December, and things are, again, more stable because we don't have all that trade noise. Companies now have their plans formalized. They know what's going on. They know how to attack these tariffs and how to kind of manage through them. Right now, for the last 3 months, I could have been saying, I'm not really sure. We're going to wait and see how things shake out. That could really choke things off and slow things down. So just one thing to consider, that maybe things, while they were somewhat troubling, were maybe troubling for a reason.
And there's another good point in there that wage inflation came in above expectations at 3.9%. So, we talk about inflation and everything else, but wage inflation going up, that's something that is very good for the economy. The more money that people have in their pockets are out there, spending, which is a great thing.
Yeah, I think that is the best part. the labor data that we saw was, again, good wage inflation. And again, you pair that with decent inflation numbers over the last several months, you're actually seeing real wage growth, which is positive for workers as they can, again, spend that paycheck rather than all of it going towards inflation and losing it. They see that growth. One last point I wanted to get to on the labor market. I kind of talked about why I don't think there's going to be robust hiring and robust payrolls is, I don't know if we can fill that amount of demand. And we saw a JOLTs report this last week, came out 7.4 million job openings. But a large problem is, do we have the people to fill it? And one thing that we've discussed in the past is an aging population that has seen assets climb tremendously, which has enabled many near retirement to have that luxury of retirement. While I don't want to say it's negative, I don't want to say, you shouldn't retire, you've worked your whole life, you can't retire. It does have an impact on, of course, this labor data. If you actually look at the working age population of those between the ages of 25 and 54, the labor force participation rate for that group remained near historical highs, around 83%. We are seeing people in that demographic work, but again, you're 64 and you have that ability to retire. Well, now you're not going to be able to fill that job opening because you're like, I'm good, I don't need to work. That could cause problems, obviously, in payroll growth if we have more people continuing to retire, as we've seen this price appreciation in the stock market, in the real estate market, pretty much all asset classes.
Yeah, and we, again, on the individual side, working with individuals and individual clients, we have seen that a lot where people are retiring. I've had people retire in their 40s because the assets have accumulated and they were good savers. It's not like they were tech people that exited a business with $20 million. Normal people have been saving and the markets have been going up. So it gives people that ability potentially to retire earlier than they thought. And now what's going to happen with those vacancies? Yeah.
So, I think the moral of the story here with this labor report is, it's questionable. There was some bad news in it. I don't want to sugarcoat it. There was some bad stuff that we did see. But again, one data point, one report is not enough for me to panic and say we're going to have a recession by the end of this year. I don't think that's going to happen. Maybe if we have 3, 4, 5 bad employment reports, yeah, we'd probably be heading towards recession, but I don't see that happening.
When we tell you to panic, you should really panic, because anytime there's any type of negative news, yeah, it's bad, but this is okay. So
not that bad. Well, with that, let's turn to something that I'm going to say that was a little bit more positive. We did get Q2 GDP in this past week, and we saw some positive news as Q2 GDP did jump to 3% and easily topped the estimate of 2.3%. But it's kind of funny. We're like, well, it's not as bad on the labor market, but with the GDP, while that 3% number sounds good, it's not quite as strong as the headlines indicate. And a big reason for that is, again, I talk about the tariffs, I talk about the messiness that we've seen in the economy the last few months. It really impacted trade imbalances, inventory building, and if we look at Q1 compared to Q2 is kind of the opposite. Q1, we had negative GDP, but because of all the messiness, you dig down deeper, it's like, actually, the report wasn't that bad. Now, Q2, because of all the trade messiness, it's like, wow, things look great. And, I don't want to say they're bad, but they're not as great as the headline showed.
Yeah, so essentially, it would help to look at both of these two as a whole, because, one looked bad because everything was being front-loaded in to try and get ahead of tariffs, and so it looked bad, and now we have these good numbers, but a lot of, the bad part of what should have been in this quarter was just pushed onto the first quarter. So quarter one, the report came back bad, wasn't actually bad because of what happened. This is kind of the opposite, where the numbers look good, but they're not quite as good because of what happened in Q1.
Yeah, let's talk about those numbers. Q1 companies, they were likely again trying to get ahead of the tariff, so they were really front loading a lot of those imports. That led to a 37.9% increase in imports during Q1, which subtracted 4.66% from the headline GDP number. Well, then in Q2, we saw a complete reversal of that as imports actually fell 30.3% and added 5.18% to the headline GDP number. That's not normal. Trade normally does not move the GDP number by 5.5%. That is a very strange anomaly, I'm going to say. That is not going to happen, I don't think, for the remainder of the year. I think it is going to subside quite a bit.
Yeah, we should get more clarity on what's going to be happening with tariffs. We're seeing more trade deals coming on, and a lot of this stuff, April was really crazy as far as tariffs and trade goes. So people were trying to get in front of it. Now we've been in it for a couple months. Okay, well, maybe it's not going to be as bad as we thought. There's still some uncertainty. There's still some volatility, but, companies and the decision makers are getting a little bit more comfortable with, with the environment that they're in. So shouldn't be as volatile on those GDP numbers and the influence that trade is having on that going forward.
Yeah, and we talk about trade. Trade also, I think, did bleed into private inventory builds. Obviously, companies were building up inventory and then kind of working through that inventory in Q2. I should say they're building up that inventory in Q1 and worked through it in Q2. This also caused a lot of volatility in the last two periods, considering it did add 2.59% to the headline number in Q1. That is, again, the change in private inventories. But then it subtracted 3.17% from the headline number in Q2, as again, many businesses were likely working through that excess inventory. And this is where it's just so strange, right? Inventories, trade, normally not going to move the needle that much on GDP, especially since we're a consumption-driven economy. Normally, that's what you want to look at with GDP. Normally, that's what's going to move the needle on GDP. But these last two quarters, it's just been so confusing, and you really had to dig into the meat of the details here because there's so much noise with the trade and inventory builds that really distorted, I'd say, the headline numbers.
Yeah, and something else good in the Q2 GDP report had to do with the consumer. So consumer being a main driver for the long term held up pretty well. There was a 1.1% increase in services spending, and goods saw an increase of 2.2%. So increases on both of those numbers, which is good.
Yeah, and I like to see that. One thing to consider is obviously consumers also knew about tariffs. Was there a little bit of a pull forward in demand on the goods spending? Again, a 2.2% increase is nice to see, but we are primarily a service-driven economy. When you think about where people spend a lot of their money, it's going to be on services. So having that 2.2% lift on goods, could that actually subside now in Q3, Q4, and really, again, detract from growth as we move forward? It's something that I am keeping an eye on, because if that does slow and services doesn't pick back up, well, you could be looking at a GDP growth of maybe 1-2% as we exit the year.
Yeah. So, again, it's all these numbers need to be looked at consecutively. So one number by itself doesn't tell us a lot. So seeing how this evolves going forward will give us a better picture on what everything's going to be looking like.
And one thing as well that got a lot of headlines this last week was obviously the Federal Reserve meeting. And, the big question around all this economic data is, are we going to now see rate cuts? And the market didn't like, the fact, the market knew we weren't going to have a rate cut on Wednesday.
I don't think anybody thought that there were going to be rate cuts. But the verbiage or the explanation for it, they didn't really like.
Yeah, and it seems, when I first read it, I was like, oh, it seems like Powell's maybe not going to cut in September. But to me, he said, we have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration, all the information we get as we make our decision. So I wouldn't say it was necessarily dovish where he's going to come out and say, yeah, we're cutting rates in September, but I don't think it was as hawkish as a lot of people were worried about, saying that he was absolutely not going to be cutting in September. I think now pairing, again, a GDP report that was okay with a labor report that was questionable, I think now you could be really looking towards that cut in September because the economy is not advancing aggressively. I'd say, in fact, it's slowing quite drastically.
Yeah, and now with the information that we have with the reports on Friday, I think the case for a September cut is a little bit stronger. After Wednesday, I think people really discounted the chances of seeing a cut in September, but now I think people are looking at that a little bit more. Not only, previously, market has been doing well partly because rates were expected, and then when Powell says, well, maybe not, that kind of hurt things a little bit, but now it might be, well, because of those somewhat negative numbers that we see on Friday, cuts might be necessary to keep the economy going.
Yeah, and I would be surprised, again, if data maintains itself around these levels. I would be shocked if they didn't cut in September. I think we'll likely need to see that cut to help with the economy a little bit, but we do have 2 more jobs numbers, and I think 2 more inflation prints between now and the September meeting. So there is still more data for the Fed to analyze to really make that final decision. But we did see 2 dissents, which was the first time that's happened, I think, in like 30 years. Mm-hmm. There's 2 Fed members that did want to cut. So, there is that, I don't want to call it infighting, but there's that disagreement. There's that discussion now occurring within the Federal Reserve of, yeah, we should start cutting. So, I do think we'll see a cut in September. At this point in time, I'm still looking for 2, maybe 3 cuts as we exit 2025. But unfortunately, I don't ask for my votes just yet at the Federal Reserve. We'll see what happens. Well, last topic we're going to talk about here today is should banks be responsible when their customers get scammed? And obviously, it's terrible to see somebody in their 60s, 70s get scammed out of their life savings. And unfortunately, we talk about this, but online scams just seem to keep growing and growing. And according to the FBI, in 2024, online scams totaled $16 billion, which is a 33% increase from 2023. Just something that I hate to see. We've kind of been, unfortunately, on the other end of seeing our clients get scammed, and sometimes there's nothing you can do.
When it has happened, we did everything that we possibly could and more to prevent it.
We even were able to try and block the distribution, but they're able to then just go to different institutions.
Yeah, if they take their money and go to a different place, we don't have any control anymore. So
yeah, and I'd say we have more control than a bank because we are the advisor. We have a little bit more, I think.
We have a better relationship. Client, so if they say, "Oh, I met this guy and he's really nice to me. I've never actually met him, but I met him online and now he needs $100,000." That's probably not real.
And I laugh, but it's
sad.
Funny. It's
sad.
Terrible.
And
it is so bad.
The question is, not is that good or that bad. Everybody believes that that's a bad thing. The question is what should be done or who is really responsible for trying to mitigate that in addition to the person. Because, if they're a victim, usually it's elderly people, they don't necessarily know what they're doing all the time. So family members, banks. So is it the bank's responsibility to have restrictions or regulations to try and prevent this even more so from happening? That's a question.
Yeah, that's definitely a question I think some are posing. It's like, well, banks should be responsible for it. And I'll kind of talk. I don't think banks should be responsible for it, frankly. A couple of reasons. One is on the the business side, one is on the consumer side. The business side, when you look at banks are already trying to prevent money laundering, terrorist financing, and other types of fraud that is costly for the banks to maintain. Adding then another oversight would be another expense for the banks, which could then lead to costs elsewhere. To offset the increased oversight expense, well, they might then either cut, what you get on the deposits at the bank, or they might then increase the interest rate that they charge on the loan. I mean, there could be an additional banking fee in certain areas. You could see added expenses to make up those costs elsewhere in the banking system. And, I just don't think it'd be worth it, essentially, at the end of the day.
Likely that's what would happen. Yeah. The purpose of a bank at the end of the day is to make money like any company. And so I'm sure that there's not a lot of sympathy out for a lot of banks, because banks do make a lot of money. They're very profitable. So it's like, oh, well, they can handle it. Well, the way that they would handle it is potentially adding costs on everybody. And even that point, I don't think is the main potential issue here. It's, well, not only are there extra costs that would essentially be passed on to the account owners or the consumers, but the other side of it is just the frustration that the you as an account owner would have to deal with if you want to get your money. If there's another hoop that you have to get through, and you're trying to move money around, or you're trying to get money, or you're trying to do something, it might not be as easy or quick to be able to do that if there's that other.
Well, I mean, yeah. Let's say you add that restriction, and you're going in. Maybe you're trying to buy a house, let's say, and you're like, I need $200,000, and you didn't really warn the bank of it, and it triggers a red flag. Well, now all of a sudden it slows down that process. Is that going to make you very happy as a consumer? Probably not.
No, definitely not. And you could say, oh, well, when you buy a house, you wire it and you can move money around. Or I think a more common thing is, what if you are in a different place than you usually live? So if you're on vacation or something and you need money, maybe there's an emergency and you're trying to get your hands on money. So, if I'm in Idaho in the middle of nowhere and a car breaks down, I need to be able to get my hands on cash as quick as possible. Oh, well, is this really you? Sorry, we're not gonna, this is a scam. And so that's, I think, the thing that would be more likely to get a broad number of people's attention. Is that something that we want the banks to do? Because again, it would potentially put a restriction on everybody as far as accessing money. That doesn't mean that we're pro scamming. Yeah. That's not the point at all. It's just, whose responsibility is it? And really, what would that look like if banks had to implement that as far as, your ability to use the services of that bank?
Yeah. I mean, it just kind of no surprise here, but attorneys in some states have started to go after banks, saying it is their obligation to protect their clients' assets. And there are laws out there that were passed in the 70s that do require banks to report suspicious money laundering activity, and even required banks to screen for fraudulent activities. But the big thing is, this protects against criminal impersonation. So somebody calls the bank and says, I need $20,000. It's really not you. Yeah, that's what it's protected against. It's not protected against you calling the bank to pull money out and then to give to somebody else. That is where that question is going to be very hard,
right,
of who is responsible. And ultimately, I hate to say it, but it's got to be the person. There has to be education. You as a family member, if you have an elderly mom, dad, you got to educate them.
Yeah, absolutely.
So again, there's a lot of bad news out there with the scamming and everything else, but we got to keep our eye on it and hopefully keep educating people about it. But we'll be right back after a quick break. Again, we're going to talk about Hasbro, Chipotle, Baker Hughes, and again, hidden benefits, not so much talked about benefits of Roth IRAs. We'll be right back. Alrighty, welcome back to the second half of the Smart Investing Show. And again, this segment we're going to talk about Roth accounts, some benefits there that you might not be thinking about. We're also going to talk about 3 different companies. We're going to look at Hasbro, Chipotle, and Baker Hughes, but don't want to waste any time there. Let's jump into it. Harrison, I'll kind of give you the floor here. What's going on with Roth accounts?
What's going on with them?
Well, are they good?
It depends. It depends, right? So I'm mainly going to be talking about Roth accounts here, but I don't have a preference one way or another, so I'm not promoting them as better than pre-tax accounts or other types of accounts or anything. These are just some components of it. And ultimately, when you're making the decision of, should I contribute to a pre-tax account, or should I contribute to a Roth account, or should I convert from pre-tax to Roth, the main thing that you have to look at before getting into the details of these other nuances is, what's your tax rate now and what's your tax rate going to be in the future? That is 80% of the issue right there. If your tax rate is high now, pre-tax is probably better. Get the tax deduction when your tax rate's high. If you think that your tax rate later on could be high because you're going to have RMDs, or you're going to have pension income, or you're going to have inheritances, or whatever accelerated income you might have in the future. Well, maybe a Roth account now would be better so that you can access that money tax-free when you're otherwise your tax rate is higher. So that's the main thing.
I would just say, the funny thing is, you have to also take an objective view on this. Is your tax rate high? I think most people, you ask them, are they paying too much in taxes? I would say most people would say,
I'm
yes.
not paying enough. I wish I could pay more taxes. No, you're right. You're right. Everyone thinks that they're paying more in taxes. I talked to somebody earlier this week, and they're like, I got crushed on taxes last year. I owed money. Oh, how much? $3,000. Okay. That's a lot of money. $3,000. Yeah. I'm not saying not, but I mean, $3,000 is more than $500, but it's also less than $60,000, for example. So everything is relative. Yeah. Everyone thinks they're paying more taxes than necessary, and that's why you have to look at the rate that you're paying.
Not the refund or what you owe. That's the worst thing you can do.
The refund or the payment that you have is almost irrelevant, because the tax that you pay is based on your taxable income, which is the accumulation of all the income that you have. That gets applied to the tax brackets. That determines your tax liability. You getting a refund just means you paid more throughout the year than maybe you should have. You making a payment at the end of the year means you didn't have enough withheld, or you didn't, make, enough payments or estimated payments throughout the year. That's all that means. So when you're looking at pre-tax versus Roth, again, what tax bracket are you in on the federal and state side versus what is that going to be in the future? That's really what it comes down to. And you can say, well, we don't know what tax rates are going to look like. That's true, but you also should have an idea of what your income is going to look like based on, your Social Security, your pension income, the amount of money you have in pre-tax accounts. Money that you have in an IRA is income. It's going to come out. It's going to be taxable. It's just a matter of time. So based on the amount of money that you have and what that'll grow to, you can get an estimate for, okay, well, this is approximately the range my future income should be. Based on that, this is the tax bracket I should be in, and that's, how you determine that. But anyway, getting into the point that I wanted to talk about here, when you look specifically at the Roth accounts, there's three things that are kind of secondary little benefits that come from that. First of all, Roth accounts don't have required minimum distributions. So right now, the age to start those RMDs, as they're called, is age 75 for anybody born year 1960 or later. So you have to take those starting at 75, and every year you get older, you have to withdraw a little bit more from the pre-tax accounts. Roth accounts do not have to do that. And the taxation versus tax-free component of it is not really what matters in this case. What I'm talking about is the fact that you don't have to take a required distribution means that money can stay in that tax-free account and continue to grow. If you have a pre-tax account, even if you have to, pay taxes on it, whatever the tax rate is, the fact of the matter is once a required distribution happens, that money can never go into a retirement account again. It cannot go into a tax-advantaged retirement account. It can go into a taxable account, but from that point on, all the earnings will be taxable every single year. So any interest, dividends, capital gains that you have are all taxable. So the fact that Roth money allows more money to stay in a tax-advantaged vehicle for a longer period of time, as opposed to forcing you to take it out and do something else with it, that's a benefit.
I would say, too, you think about this long term, we see this sometimes, they retire and I don't want any money. I want to leave it to my kids. Well, that's really nice. Is that right or wrong? I don't really care. It's your money. Do what you want. Right. But you think about now the benefit, right? You're not pulling any money from that. Then when the kids inherit that money, as opposed to a pre-tax IRA or a pre-tax 401k, you have to be very careful. Otherwise, you have a ticking tax time bomb for 10 years where you'd have this huge tax liability, where if you inherit a Roth, you have 10 years essentially where you wouldn't have to pull that out, and all that is tax-free growth. It is definitely a hidden benefit that is
and that's
huge.
That point that you bring up is the second point that I wanted to
talk about. Thunder.
It's like you read in my notes here. No. Because again, you don't have to take the RMDs when you're alive. But the next point, as you say, Chase, is from an inheritance perspective, a Roth account is better. Both pre-tax and Roth accounts are subject to a 10-year rule, which means if they are inherited by somebody who's not your spouse, like your kids, for example, they have to deplete that account over 10 years. Pre-tax accounts are still taxable, so generally what the best thing to do is just take equal amounts over those 10 years because it's income, and that way you don't get pushed into a higher tax bracket. But the reality is, if you inherit $1 million pre-tax IRA, you might have to withdraw $100,000 or $125,000 a year every year for 10 years on top of the income that you have. That's probably enough to push you into a higher tax bracket. With the Roth account, you still have 10 years, but it's all tax-free. And you can wait until year 10, so get 10 years of extra tax-free growth. And then as that beneficiary, you just withdraw it all in year 10. So if you inherit $1 million and it grows to $2 million, that extra $1 million of appreciation is also still tax-free to the beneficiary. So from an inheritance perspective, Roth is better than pre-tax. And I was
just gonna say that I would not be surprised if that changes.
I think it
over
will
time, because it's like just that benefit is so huge that I don't think it's gonna be now a negative to inherit Roths or a negative to have a Roth in retirement.
No,
but it's just gonna be not as big of a benefit.
The playing field between that and pre-tax accounts might get leveled, because right now Roth accounts in that context has the advantage. So no RMDs and better from an inheritance perspective. I think both of those potentially will change. I think there could be required distributions that happen. The reason why required RMDs happen anyway is because the IRS says, well, we've given you this benefit of deferring your income. Now we want tax revenue from that income, so they make you start doing it. But the other benefit is from the Roth side is, well, you're just keeping that money grow tax-free as opposed to withdrawing it out and then investing in something else that's ultimately going to be taxable. And then the last thing that isn't as important for most people, but it's still a benefit, is the estate tax impact of it. And so right now, and the reason why I say it's not as important is right now the estate tax limit for a married couple is like $28 million. And now with this tax bill that got passed a couple weeks ago, that high limit got made permanent until it gets changed again by whoever. But there's no sunsetting of that, so that estate tax limit is not going to be cut in half starting in 2026. But when we look at pre-tax versus Roth accounts from an estate tax perspective, both the full value of an IRA and the full value of a Roth account are included in someone's taxable estate. So if you have $1 million in an IRA and $1 million in a Roth, you're going to pay the same tax rate from the estate side on both of those accounts. In addition to, you're also going to pay, your income taxes on the IRA as well. So when you look at the fact that pre-tax money is taxable, $1 million in an IRA is equivalent, depending on your tax rate, maybe to like $700,000 in a Roth. So, but if you happen to die and you're subject to estate taxes, even though from an income tax perspective, those accounts are essentially equivalent, you're going to pay the 40% estate tax on the full $1 million IRA, where you'd only pay it on the $700,000 in the Roth.
So kind of the way I'm thinking about it is, let's say, just for simplicity, you're worth $15 million and you have $1 million in a IRA, and the rest is in real estate that you don't want to liquidate when you inherit it. You're going to have to pull that money from the IRA, but the problem is, to pay that 40% estate tax, it's going to have to come out of the IRA. Then on top of the estate tax, now you get taxed on the distribution amount as well,
yes.
where you wouldn't have that on the Roth.
There is a little bit of a deduction the estate gets when IRA money has to be depleted from it, but it's not enough to fully offset the cost of having the money. So, 40% of $1 million is more than 40% of $700,000. So in that scenario, it'd be better to try to get money into the Roth. You're still going to pay the income tax anyway, whether it's now or later, and if the rate's the same, you're better off getting into the Roth so that $300,000 difference isn't subject to the estate taxes as well. So those are the three benefits. But again, I'm not like pro Roth or anti pre-tax or anything like that. I have both accounts. So do you, Chase. So does Brent. Doesn't have any Roth accounts, I don't think. It depends on the situation.
Yeah.
So but these are just some extra secondary benefits that sometimes are helpful, but I do see potential legislative changes in,
I think there should be from a taxation perspective.
Probably, yeah. I mean, I don't think it's been talked legislatively that it has a little bit, but I don't think there's been anything really done because it's not very common to see extremely large Roth accounts
yet.
Right, exactly, because Roth accounts are relatively newer. Like, we've seen an IRA with $8 million in it, or $10 million in it, which is a lot because you're limited on how much you can contribute every single year. So not only do you need to max that thing out for a long time, but you also need the money in there to grow a lot to be able to, grow to $8 or $10 million in an IRA. I've never seen $10 million in a Roth. I've seen $1 million a few times, but it's just not as prevalent, and I think that's why legislatively they haven't done much with it yet.
Yeah, I don't know the full numbers on how much is in Roth IRAs versus pre-tax. I'd assume, again, there's still more in pre-tax and Roth.
There's way more.
Why it's not as discussed, but I think that'll continue to kind of narrow. And as that does narrow, I would not be surprised to see changes. But
pension money's pre-tax. So when people have lump sum pensions, that gets rolled into a pre-tax account. Right now, matches are pre-tax. So there's just more contributions going into the pre-tax side of things. So, and that's probably always going to be the case. Pre-tax is probably always going to be more popular, or at least a larger number of assets. But the Roth accounts are growing. So we'll see how it goes. But again, a couple little benefits to keep in mind, Don. If you're very close, if you're like in the same tax bracket and you're always going to be in that tax bracket, I would probably gravitate toward a Roth better than a pre-tax, or try to convert into a Roth.
Yeah. Well, as always, Harrison, great information there. And it is so dependent on, again, that person's situation in their financial plan. So if you are interested in setting a time with Harrison and learn more about financial planning and what he does for his clients, including why he might like Roth or pre-tax for your situation, give him a call. Phone number here, 858-224-0004. Again, 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. With that, we'll now turn to companies. So first company I want to talk about here today is Hasbro. Now, they're obviously that toy maker. Reason they're interesting here, the shares did trade up after they reported second quarter results that beat analyst expectations. Company earned an adjusted $1.30 per share on revenue of $980.8 million. This is where it's crazy. Analysts were looking for a profit of just 78 cents, so $1.30 versus 78, and then revenue of $880 million, so $100 million beat on that. So it was a very, very good quarter. They said it was fueled by performance in their Wizards business is what kind of lifted things. So
Wizards, huh? Hasbro. So, you know, household name, you probably heard of it, American Toy Entertainment Company. They've got iconic brands like Monopoly, Transformers, My Little Pony. I know that's a big fan of Chase. Chase really likes that one. Nerf, Play-Doh. But then also back to the Wizards, Magic the Gathering and Dungeons and Dragons are, you know, in that Hasbro umbrella, and they make a lot of money for them.
Yeah, I mean, I know kind of Monopoly is the one that's iconic to me. I mean, I actually got a Monopoly board right behind you right now, the Berkshire Hathaway edition. But as always, let's look at the numbers here to see if Hasbro is a worthwhile investment. I like it too because it's not overly complex. You know, I mean, I don't think toys, entertainment for kids is going to necessarily go anywhere. The question is, will Wizards and Dungeons and Dragons, is that something that will continue to grow in popularity, or will it decline in popularity? I know a few years ago, actually, that segment, their Magic segment, hit their stock pretty hard as expectations were way off. So, I mean, I don't know how big of a business that is for them compared to the monopolies, compared to the other kind of nostalgic areas like My Little Pony for me. But would want to understand that breakdown there for sure, as do they have potentially growing assets, growing products that can kind of continue as we progress through time here.
Yeah, I mean, it looks like in 2024 that Wizard segment generated, let's see, over $1 billion. Yeah, Magic the Gathering was over $1 billion. That looks like that's quite a bit bigger than Dungeons and Dragons. That's like $200 to $300 million of revenue. And then the other games account for like 30 to 40% of their revenue. So Magic the Gathering is a really large component of where their revenue comes from.
Do you know anybody that plays Magic the Gathering?
No,
me either. So
but I mean,
I don't know if it's popular.
I don't know how much a card costs. I mean, $1 billion of revenue from that. I mean, I know that like Pokemon cards and stuff, people buy those things for tons of money. Maybe this is something similar where people really buy a lot, and ultimately, from a business perspective, sell whatever people buy. I mean, who cares?
No, absolutely, yeah. It just if it was, let's say, 60% of the business, I mean, that could have a large impact. I'm not sure if that's the numbers.
It's about 52% of their Hasbro gaming revenue is Magic the Gathering.
Oh, I'm kind of surprised by that. But let's look at the numbers behind the company. Right now, kind of surprised by this. No price to earnings multiple. There must have been some write-offs or something that impacted that. I do believe they have profitable business lines in the long term. So again, must just be accounting situation there. Price to sales were 2.5. Price to book value, nothing there for the tangible book value. Likely a lot of acquisitions that they've done over time, create a lot of goodwill on the balance sheet. Price to cash flow, 15.2 below the industry of 15.5. PEG ratio going forward is 10. Big reason for that is the estimated growth rate on earnings. Not very impressive here, just 1.5%. I'd like to see, obviously, more growth when buying a business than a long-term earnings growth of 1.5%. Sales over the last 1 year did decline 6.2%. Earnings were flat. So again, kind of curious what's going on there. Is there that catalyst that could turn things around and get Hasbro growing again? That's a big question for an investment thesis in this business. You get a decent dividend, though. Yield is about 3.8%. They do use 91% of their earnings to pay that out. But to me, more importantly, because I think there's some accounting issues, the free cash flow payout ratio is 78.6%. So I think that dividend appears to be safe and stable at this point in time. Definitely disappointed by the balance sheet. Current ratio looks okay at 1.7, but gosh, debt to equity 290%. Definitely above my comfort level at this point in time. Now, looking at the current price for Hasbro, it's $74.63. The 52-week high, wow, $78.83. And I say wow because the low here is $49. Year-to-date return for Hasbro, 36.3%. Definitely done quite well. Long-term, though, not done well. Over the last 3 years, up about 7.9%, including dividends. 5-year return, 24%, and the 10-year return, just 28.7%, all including dividends. So a lot of that growth obviously came with that year-to-date period. Unfortunately, long-term, you held Hasbro not doing well. Now, the question is, going forward, is this a worthwhile investment? I'm going to say it's okay. Reason being, estimated earnings per share, we got to December 2026, $5.06. Gives us a target sell price of $84 a share. Again, when I say that current price was, it was somewhere around like 74, I want to say. Not much room for appreciation above it. And I got to say, it wouldn't be a buy because that balance sheet, debt to equity, just not worth it in my opinion.
I also found more about Magic the Gathering.
Let's hear about it.
That 52% number was of the Hasbro gaming segment. So looking at all segments of total revenue, it's about a quarter of total revenue, which is still a lot. But I was like, 52%. There's no way. There's no way that there's that many people buying those cards. So,
especially with a large company like that.
Yeah, but I mean, still 26% of revenue because I mean, Transformers. They also license. Disney Princess from Disney. I mean, there's some pretty well-known Monopoly. So the fact that a quarter of it is coming from Magic the Gathering, I think that's a pretty niche thing.
Yeah, I would agree with that. So, and again, is that niche growing? That's a big question, especially still at 25% of revenue. Let's
26,
say.
Yeah.
I mean that's got to be a big weight on that company. They need that to grow to really have a good impact on this business. So. Like I said, I was kind of hopeful here. I liked the underlying premise of the business, simplicity. But again, the valuation is meh, it'd be in the hold category, and the debt just not worthwhile. Next company, let's take a look here at Chipotle. I think we all know Chipotle. I say we all. I don't know if they're as nationwide or as prevalent nationwide as they are here in California. I know they are across the country, but you know. Maybe some people in the Midwest might not be as familiar with Chipotle. I don't know. But let's look at the numbers here for Chipotle. Current price to earnings. I was disappointed by this because the stock has just really fallen under pressure lately. They missed pretty bad last week on same store sales and then posted weaker revenue for the second quarter. Led to a big decline in the stock price, but price to earnings still 37.6 above the industry average at 31.1. Price to sales at 5, more than double the industry average at 2.4. Price to cash flow 27.7, above the industry average at 17.3. I mean, it's still expensive. And the reason it's expensive, I'm surprised by this. It's still growing. I mean, earnings per share over the last 1 year up 11.1%. Sales over that time period up 8.6%. I didn't think Chipotle had the ability to grow at that same capacity over that last year, as I thought they were, again, more established than, 5-10 years ago, but they still look like they're maybe expanding store count and somehow driving further revenue.
I mean, Chipotle, that company has always been strange to me. I mean, their multiple that they've traded at has always been way higher than other fast food chains and things like that. But it looks like their stock price kind of peaked out early 2024, and that was around the time when they came under fire for having smaller portion sizes or reducing portion sizes or being a little bit more variable in the portion size that you were getting. And since then it's down quite a bit. It kind of got up to, over $60 a share. And now it's at $40 a share. So it's lost, a third of its value since that point.
And I wonder, I mean, I haven't been in a Chipotle in a while.
I was in one randomly like a couple months ago, but I don't go there very often.
And one thing that always concerns me with these companies is, you have this tremendous growth. And Chipotle, again, has had this growth engine for many, many years where it's been able to open new stores. And I don't want to say the growth is easy, but obviously when you go from 100 stores to 200 stores, it's much easier than going from 200 stores to 400 stores. I'm not sure where they're at now, but that growth gets exponentially harder the bigger that you get. Mm-hmm. At some point, this valuation that they're trading at, which, I look out to December 2026, estimated earnings per share is $1.42. I mean, our target sell price is still $23.57 compared to where you say it was still trading around 40.
It's over 40 right now. Yeah, 42.50. I think is what it closed on Friday.
So, I mean, that still gives us a forward PE multiple of, let's see here, 1.42. I mean, it still trades at about 29.9 times those future earnings, for a business that I wouldn't say has overly secure cash flow, overly secure sales, and tremendous margins. A lot of times people make the excuse for big tech companies that, they have secure revenue base and very strong margins. I don't think you can make that case with Chipotle here.
Did you have the comparison to the industry, Chase, for some of the earnings multiples on that?
Yeah, I mean, the earnings multiple, I was surprised by this for the industry, is 31.1 versus 37.6 for Chipotle. That's, again, on a trailing 12-month basis, not a future basis. But I can't justify paying 30 times earnings for a burrito company that doesn't have great margins. I mean, I say doesn't have great margins. I want to give them credit where credit's due. Obviously, their profit margin is 13%. That's good, but it's not like the big tech companies where they have these very, very strong margins. Mm-hmm. And I think that can change very quickly because all of a sudden sales dry up. Well, your margin dries up very quick as well. And if we did have a slowdown in the economy, I'm pretty confident people wouldn't go to Chipotle as frequently.
I don't know. It's tough to say. I mean, would people go? Because, I mean, I think part of the reason why, the culture, you could say, liked Chipotle is because it was decent food, decently healthy. It was kind of, a place that wasn't, it's not like getting a cheeseburger at McDonald's, maybe a little bit better than that. So it was kind of like, quick, hit all those targets. It was pretty fast, pretty healthy, not too expensive. It's gotten more expensive and the portions have gotten smaller. I think that's, part of the reason they got some negative press there. But I don't know. Would it be an alternative for people from maybe some more expensive types of foods to go to Chipotle? Or if people, it is still relatively fast. Yeah. So I don't know.
Yeah, I mean, I definitely think they created a great business model. I know their CEO, Brian Niccol, for many years, he did a great job. Now he's at Starbucks. Is that regime change? Is that going to cause problems going forward? Was he that star CEO that was able to carry Chipotle for many years? I'm not sure, but I can tell you one thing's for sure. I mean, their debt to equity is 140%, not worth a questionable balance sheet and a high valuation to buy Chipotle at this point in time.
Yeah, that's what it comes down to. So.
Last company we'll take a look at here is Baker Hughes. Interesting in the media, they did purchase a company by the name of Chart Industries. I've never heard of Chart Industries, but the acquisition is for about $13.6 billion. They are a gas equipment manufacturer. Baker & Hughes is in the oil and gas equipment and services industry. And I thought this would be interesting, obviously, with the trade deals coming about. One of the big things that, President Trump is kind of touting is other countries buying our energy, buying our natural gas. Could this be a lift to a company like Baker Hughes that is in that space? And I know you got some more information on what Baker Hughes does, so I'll kind of let you fill the listeners in on what that is.
It's a major energy technology and oil field services company. It's headquartered in Houston. It operates globally and provides products and services across the oil and gas value chain, upstream, midstream, downstream. So all kind of in that oil and gas field. So the core business segments, they have their oil field services. That's the traditional bread and butter business. It includes drilling, evaluation, completion, production services for oil and gas companies. It's heavily tied to global drilling activity, rig counts, and things like that. Also, though, they've got some of the transitionary alternative energy sources. So it looks like they're trying to diversify a little bit into that type of stuff. But they're mainly what they do is oil and gas and everything involved with it. They work with a lot of different oil and gas industry, companies, and so they're a big player in that.
And I do wonder too if they have, I'm going to say, less operational risk, right? Because they're not actually operating the wells. It seems like they're setting them up. It seems like they're selling the equipment to operate.
That's kind of what it seems like. They're selling the shovel instead of digging for the gold, so to speak.
Yeah, which generally I like to see, and I was kind of hopeful on this company, but definitely some question marks. I mean, you get a decent yield of about 2.1%. The balance sheet is clean, so I mean, even with this acquisition, their debt to equity is 30%. So even if you bring on this company, I don't think it's going to destroy that balance sheet. But when I look at the current price of $43.51, it's done okay. It's about 7% year to date, but I was shocked by this. 5-year return, 226%. It's done really well over that time period. And the questionable point is now you go out to December 2026, estimated earnings per share of $2.65 gives you a target sell price of $43.99. Again, you compare that to the current price of $43.51. Not much room for appreciation to be buying it at these levels. So maybe on a pullback, there can be some opportunity, but at this point in time, I would not give it a buy rating based off that valuation. Well, thank you again for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you would like to discuss in more detail your investment needs or have other investment questions, feel free to give myself, Chase Wilsey, or Brent Wilsey a call at 858-224-0004. Again, 858-224-0004. Also, too, please visit our website at smartinvesting2000.com. Again, that's smartinvesting2000.com. You can listen to this podcast there and sign up for our Smart Investing newsletter.